Hey everybody, welcome to 5 Charts with LPL Research for LPL. This is Scott Brown. I'm excited to be with you this week. If you notice, we got a little bit different setup this week. No Ryan Dietrich. Ryan is off at what we call Masters Conference, celebrating some of the top producing LPL advisors, but we already took 1 week off when I was on vacation a couple weeks ago, so we wanted to make sure that we were able to bring this webinar to you this week. So we're going to get right into it this week. The latest 5 charts with LPL Research have, sometimes we try and make this show a little bit fun. We show things like we showed last week, European coal futures just going crazy, not even that much to say. This week we decided to, mix it up a little bit, show everybody what we think are maybe the 5 most important charts. There's a lot of important charts, but what are 5 of the most important charts for the major indexes, what we're seeing from kind of a macro strategy standpoint, and what we think investors really should be focused on here today. So again, first up, let's start with what everybody always wants to know about, the S&P 500. Now, there is some good news. The good news is that we still haven't undercut those February 24th intraday lows at about 4,114. That's the good news. The good news also is that so far this week, it looks like we're carving out a little bit of a very, very short-term base. Monday and Tuesday were really rough, but Wednesday, Thursday, and Friday, we've managed to rise, setting up for a good into the week here. And if we can close positive, we think that would be a good short-term sign and send the S&P 500 up for maybe a test of that downtrend line near 4,400 sometime next week. So that's what we're watching. On the internal side, we aren't seeing as many positives. We actually saw we see 52-week lows continuing to expand. Nearly 80 stocks in the S&P 500 did make 52-week lows earlier this week. That expanding while price hasn't undercut those lows is not exactly what we're looking for. So we continue to monitor those internals because it's kind of in this precarious position where it's not bad enough to be called a flush out, but it's also not necessarily, a good sign when you see 52-week lows expanding, and we're certainly not talking about just 1 or 2 stocks. When you got 80 of the most important U.S. stocks making 52-week lows, that tells you something about the market trend that we are dealing with. The next thing that we want to talk about, bonds. We got equity market weakness as diversified investors, growth of income type investors, following maybe a 60-40 split. You expect your bonds to hedge in this type of environment. That's what we've all come to expect. Unfortunately, that's not what we're seeing so far year to date. And from a purely technical standpoint, we may not expect to see that for the rest of 2022. Over on the left-hand side, we've got the 10-year Treasury yield, which has been remarkably resilient. As we record this, the S&P 500 is down more than 10%. The 10-year Treasury yield is about 5 basis points off multi-year highs. Has really been accelerating so far this week. And you look back, we managed to hold that about 1.7%, arguably the breakout point from a gigantic base. We also look at the 30-year yield later today on the LPL Research blog, LPLResearch.com. It looks like it wants to follow suit and break out of this multi-year base going back to 2019. This move on the 10-year yield targets potentially 3%. And on the 30-year yield, a breakout above 2.5%. targets 4%. So we just really need to be aware that, yes, bonds are off to a bad start, but we might be looking at the first ever consecutive negative years for the Bloomberg Aggregate Bond Index with history going back to the 70s. So, just something to be aware of. Bonds aren't hedging, but also the Fed isn't coming to save us. Over on the right-hand side, we've got Fed fund futures for where the market expects the Fed funds rate to be after the July meeting. Now, we've got 4 meetings, July being the 4th meeting, but we've got 4 meetings between now and July. We got March, May, June, and July. The market is saying about a 93% chance we get 4 hikes in 4 meetings, and a better than a coin flip, about 60% chance that we've got 5 hikes in 4 meetings. Now, it seems like Jerome Powell's come out and ruled out the 50 basis point hike in March, but the market, at least for now, still thinks that we're going to get a 50 basis point hike in one of these next 4 meetings. Maybe that will change, but right now we need to be aware that this is not a positive for equity markets, and something that maybe ties into those longer term rates rising as we see inflation expectations really rocketing higher so far this week. a little bit of a concern. This is a more modest concern, but high yield spreads keep widening. We saw more widening this week. High yield spreads are up there in orange, and investment grade spreads, while still at very low levels in absolute terms, are rising as well and pushing up towards about 1.4%. That's down there in blue. So just combined with that equity market picture, we want to see equities rally and we want to see high yield spreads tighten. We haven't really seen either of those, and so that is certainly a little bit of a concern that we continue to monitor. We want to see credit spreads tighten back closer to about 3.5% on any equity rally. Another thing that I think, everybody's talking about oil over this past week. It's commodities. We see gas prices up $4 here in North Carolina. I know they're up over $5 a gallon in other parts of the country. Maybe some good news. Maybe we just saw a little bit of a blow off top. Now, to be clear, we like the structural trend in oil, but we all came in Monday morning and we saw oil up above $130 a barrel, the highest level since the 145 all-time highs in 2008. But that move, that kind of parabolic move, actually had crude oil prices 67% up above their 200-day moving average, something that's only happened one other time in history in the middle of 1990 leading up to the Gulf War. And again, sample size of one, but that ended pretty roughly for crude oil prices. So the fact that we've pulled back below these 2011 to 2013 highs near 115, we do think is some good news. We probably would look to buy a consolidation, look to go back overweight energy on some sort of a more sustained pullback because we do like the trend, but short term, maybe some relief coming. We definitely, think that we probably won't get back up towards that 130 high point that we saw Monday anytime in the very, very near future. And then the very last chart we've got for you this week is actually not a chart. Chief Market Strategist Ryan Dietrich does a lot of these tables. You can see him on Twitter. Really, really great work. Always important to look at market history. We tend to focus on more the true technical type charts, but I thought this one was important enough that we would consider it one of our 5 charts. This is performance for the final 10 months when January and February are both negative, like we've seen so far this year. While there are a wide range of outcomes, I think the message from the average and the median return is pretty clear. We do need to lower our expectations. And again, this is the final 10 months. This is not what the yearly return is, where you're just starting behind the 8 ball and really all you're doing is showing that January and February were negative. This is what the final 10 months do. And on average, the return has been 3.8%, but the median return minus 3.4%. You're actually more likely to be negative than positive. And so again, a wide range of outcomes. Some of these 51% in 2009, where we know the market bottomed in March. But in general, it does say lower your expectations, and that does line up with some of the other things that we've seen so far on a technical basis in this webinar. So just a very important chart, something to be aware of. History doesn't rhyme or doesn't always repeat, but it does rhyme, and that kind of feeds into some of those other things that we're seeing. So that is what we have for you this week. Thank you so much for joining. Hopefully Ryan will be back with us next week for another 5 charts with LPL Research. But everybody, stay safe, stay healthy, and we will talk to you next week. For LPL Research, this has been Scott Brown.